Do you know the television game show called The Price is Right? On this iconic show, which is still running really strong after first debuting in 1956, the host encourages contestants to guess the price of a car or appliance or vacation of their dreams. The contestant who is closest to the actual price wins the prize. But for many contestants, the price is nowhere near right, which makes for some pretty good laughs. I may not know the price of a luxury camper or a major appliance, but I do know a place where the price is most certainly right, the price of our historically low tax rates. Yet when I speak to groups and poll attendees to gauge their views on current rates, I'm often really dumbfounded by their answers. Taxes are so high. Taxes are suffocating me, or they can't go any higher. Here's a newsflash. Tax rates are extraordinarily low. You might even say they're on sale. Today, the highest marginal tax bracket is 37%, but in 1944, the highest marginal tax rate was 94%. In the 70s, the highest rate was 70%. We've had numerous eras in history where tax rates were significantly higher than they are today. The reason I'm sharing this history lesson is to encourage you to consider Roth conversions. In one of the quirks of the U.S. tax code, you are perfectly welcome to convert parts of your IRA to a Roth account at any time. Roth conversions are great because once you have funds in the Roth account, they are no longer subject to taxation. Further, and this is beyond the scope of this video, Roth money doesn't figure in the calculation that determines how much tax you pay on your Social Security. Like a diet of fruits and vegetables, Roth accounts are really good for you. But there is a catch. You must pay taxes in the year of the conversion. It seems that tax rates will likely be higher in the future. Maybe not 94% like after World War II, but higher than today's discount rates. This makes conversions appealing for many of you. Many factors could cause an increase in taxes. According to the nationalpriorities.org, in 2016, the four biggest expense categories, Medicare, Social Security, Medicaid, and interest payments on the national debt, consumed about 66 cents of every tax dollar. Currently, these same categories eat up about 92 cents of every dollar of revenue. This leaves every other government agency to fight over just 8 measly cents on the dollar. David Walker is perhaps the most knowledgeable person in the country with an opinion when it comes to this situation. He's the former Comptroller General for the United States. You could call him the CPA of the USA, if you will. Incidentally, Mr. Walker is a member of the CPA Hall of Fame. I was also once a CPA, but strangely, they never called. Anyway, these are his profound words. Regardless of what politicians tell you, any additional accumulations of debt are absent dramatic reductions in the size and role of government are just deferred tax increases. Unless we get our fiscal house in order, there's simply no other way to handle our ever-mounting debt burdens except by doubling or increasing taxes over time. Unfortunately, I agree. It's a math problem. Either taxes go up or spending decreases. But in the end, it'll be a combination of the two. And I know as I record this around Thanksgiving 2021, the subject of tax policy is still front and center. I fear that current congressional leadership, as they usually do, will pay for these reductions in revenue on the backs of middle-income folks like you and me, changing Medicare or tinkering with Social Security in a way that saves the government a little bit of money, but hurts Americans where they need the help the most. If you've invested heavily in tax-deferred accounts like 401ks and IRAs, and unless you can accurately predict what tax rates will look like in the future, you really don't know how much money you have. And that makes it much harder to plan for retirement. Take it from an expert. So, conversions may be appealing. There are other factors. Just because tax rates may be higher in the future, it doesn't mean your tax rate will be higher in the future. Also, you may remember I mentioned that taxes are due on the conversion. If you're paying this tax out of another source like a checking account or savings account or funds that you aren't using, your conversion will have much more value. And finally, and this is beyond the scope of today's video, but if your investing style is more conservative, if you're an overly conservative investor, the value may just not be there for you. So it's not always a slam dunk decision, but today the price may just be right for Roth conversions. If you need help determining whether this is the right strategy for you, please reach out. If you like what we're doing here at Real Retirement Advice, please subscribe and or like and comment on our videos. Thanks for watching.